Thanks for tuning in, Dividend Dashboard here, and welcome to the first portfolio update of 2025. As usual, I will be covering the stocks I bought, dividends received, and a portfolio update in full transparency. Let's dive in. I kept it simple this month, as I am not contributing to a portfolio due to the lack of income, and January not being a high-paying dividend month. I only bought two small tranches, 0.07 of Pepsi and 0.05 of Google. Pepsi has been under fire lately. This defensive stock has been given deals that you cannot ignore. Personally, I like the diversified portfolio Pepsi offers compared to its rival. The reason for this small tranche was $2 cost average. For Google, one of my goals this year is to continue increasing my core holdings, and Google is one of them. The company has been on a roll lately, and it just keeps expanding the business and generating massive amounts of cash flow. The reason for this tranche was to increase the allocation within the portfolio. In the month of January, 9 companies paid me a dividend. JP Chase $7.44, Kimberly-Clark $5, Pepsi $6.78, Automatic Data Processing $1.58, Nike $2.82, Digital Realty Trust $9.29, and Realty Income $5.79, for a total amount of $38.70 in dividends for this month. Looking at the dividends year over year, I finally added the 2025 column, and it looks like this chart evolves over time. As I continue investing and receiving dividends, this chart will continue to expand. Now, looking at the numbers, 2020 to 2021, dividend income initiated, marking the start of passive income generation. 2021 to 2022, a moderate increase in dividend income of 17%, likely attributed to reinvestments and potential dividend increases. 2022 to 2023, substantial growth in dividend income of 312%. Due to an increase in buying high-yielding dividend stocks. 2023 to 2024 continued significant growth in dividend income of 108%, demonstrating ongoing momentum. 2024 to 2025, slower growth rate of dividend income. This is because I stopped contributing mid-year in order to preserve cash because I quit my 9-to-5 job. Now, this year I'll need to step it up. Some reflections I have during January are that, number one, I need to find a job. Without income, I cannot contribute to the portfolio. As simple as that. Number two, even though I haven't contributed for the past 6 months, it still shows consistency and dividend reinvestment is key. Despite having a slower year-over-year increase in 2025, it is 11.5 times higher than in 2021. And number three, I need to prioritize faster dividend growth. Focusing on stronger dividend growth rates than just yields will allow the portfolio to compound faster. Overall, January was an okay month, but it can do better, and I have the capabilities to do that. Slowly but surely, I've been making some adjustments behind the scenes, and I will keep you guys updated as I always do. Moving on, I have a dividend growth portfolio valued at $23,856.32, consisting of 23 holdings. The weighted dividend yield of this portfolio is 2.82%, which translates to $566.33 in projected annual dividends. Performance-wise, I cannot say it is not good or bad. The year is just starting out, so no drastic changes are expected. The portfolio is up 1.86% year to date. As mentioned, this portfolio consists of 23 holdings, a combination of blue chip companies and high quality growth compounders. Going clockwise, we have Apple, Colgate, Coca-Cola, Realty Income, Procter & Gamble, Waste Management, Clorox, Kroger, Kimberly-Clark, Starbucks, JP Chase, Home Depot, Johnson & Johnson, Nike, Digital Realty Trust, AbbVie, Texas Instruments, Hershey's, Pepsi, Visa, Automatic Data Processing, MasterCard, and Alphabet, which is Google. As mentioned, this portfolio is built around a solid foundation of blue chip companies and high quality companies across various industries, prioritizing stability, growth, and consistent dividend payments. Overall, my portfolio is well positioned for long-term dividend growth and capital appreciation. I have a balance between defensive income stocks and high growth dividend payers. With companies that dominate their respective industries, my portfolio is built for resilience, making it well suited for long-term wealth accumulation. I've been tracking my annual dividend income, and I'm really proud of the progress I made so far. My portfolio is generating hundreds of dollars in annual dividends, and it is amazing to see how my investments dividends are starting to pay me back in passive income, and this number will only continue to grow as I reinvest dividends and add more capital over time. My top 5 dividend contributors are Hershey's, $77.67. Despite the stock having negative return, it is my top dividend payer. Number 2, we have Realty Income, $68.58, loving that monthly income consistency. Digital Realty Trust, $37.14. This REIT has really delivered dividends quarter over quarter. Then we have AbbVie, $38.94, steady healthcare dividends. And last, JP Morgan Chase, $31.36, strong and reliable from the banking financial sector. Looking ahead in future plans, I'm going to focus more on dividend growth stocks, companies that have a proven record of increasing their dividend over time, but at a faster rate, not fully mature companies. With that being said, I'll be putting more money into my core holdings like Visa, MasterCard, and Google. There's other positions like ADP that deserve a higher allocation in the portfolio, but more into that in another episode. And of course, stay committed to reinvesting dividends. The compounding effect is already working, and I'll continue to put the dividends received back to work to accelerate the growth. For the third return, my portfolio saw a mix of strong gains and a few setbacks this past month. Top performers of the month, we got JP Morgan Chase with 125% increase, leading the way with outstanding return fueled by strong earnings and positive sentiment around the banking sector. Second, we have Apple with 104%. The tech giant continues to deliver impressive gains thanks to the robust product sales and innovation. 3. Digital Realty Trust, 69%. My real estate investment is paying off as demands for data centers remain high. Number 4, Waste Management, 45%. A solid defensive play that delivers reliable returns. And in the 5th spot, Home Depot, 45%. Benefiting from the ongoing strength in the home improvement market. Now I have underperformers in their portfolio as well. We got Hershey's with minus 31%, Pepsi with minus 16%, Nike with minus 10%, Johnson & Johnson minus 5%, and Realty Income minus 6%. January was a month of mixed results, but I'm encouraged by the overall resilience of my portfolio. However, that is not enough. It's time to step it up. So immediately after this video, I'll start monitoring underperformance and proceed with the goals of high grading my portfolio. The moment to act is now, so you might see changes. Other than that, I'll continue to reinvest my dividends, continue increasing core holdings, and become more disciplined to the plan. So that will be it for this video. If you made it to this part, make sure to hit the like and subscribe. Thanks for watching, and I'll see you in the next one.